Hey everyone, now that Verizon and AT&T have reported their latest quarterly earnings results, I thought it'd be a good time to compare these two dividend payers. Now, I'll compare these two on more than just their dividend yield. I'll include more financial metrics, including their valuation and their profitability, before coming to a conclusion on which one I think is the better dividend stock to buy today.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, I know many of you passive income investors are attracted to AT&T and Verizon stock because of the dividend yield. They're very close. Verizon pays a dividend yield of 6.6% and AT&T pays a dividend yield of 6.53%. But there's more to investing in dividend stocks than just getting the dividend yield. You're also exposed to the risk of the change in stock price. So you want to look at the factors that could influence the stock price, as well as the factors that can support a continued dividend payment over the longer term. And one of those factors is revenue growth. Revenue growth for profitable companies helps increase earnings per share, which is what companies use to pay dividends. Unfortunately, Verizon and AT&T have not demonstrated much revenue growth in recent years, and they're not expected to either. They're operating in a mature industry with customers already saturating the market, with companies, I should say, already saturating the market. And so there isn't much opportunity for growth from these dividend stalwarts. However, that doesn't necessarily make them bad investments. It's just one of the factors incorporating these two dividend stocks. Now, while their revenue growth might not look very good, their profitability certainly does look good. Operating profit margin for both Verizon and AT&T have been very strong, and for AT&T it's actually improving. You can see the operating profit margin at 20.16% has been moving higher since July of 2021, where it was at 16%. Meanwhile, Verizon is moving lower at 21.38%. Both solidly above 20%. That's a good operating profit margin, especially for companies with such large capital investment required as Verizon and AT&T. It's difficult to hold up your operating profit margin because so much expense goes towards depreciation and amortization, because they've spent billions of dollars building out their network, most recently the 5G network. But every few years, every generation of technology, they need to invest in that next gen technology to stay relevant. And the next thing I'm going to talk about is the cash flow from operations to sales, but I want you to understand this metric a little bit better before I go into details. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you've got this metric, you can see AT&T again doing better here with the rising cash flow from operations metric, 32% most recently, compared to 27.06% for Verizon. Another thing that is very critical when you're investing in either of these two dividend stocks is to always look at the debt. They have some of the largest debt of any business in the world. Verizon with $151.7 billion and AT&T with $132.76 billion. Verizon and AT&T have been utilizing some of their cash flow to pay down some of this debt. 5 years ago, they may not have wanted to do that because they were able to borrow at such low interest rates. Nowadays, however, after the Federal Reserve has increased interest rates, when this debt comes due, AT&T and Verizon are finding they have to refinance at higher interest rates. Instead, they're choosing to pay down some of this debt incrementally. Now, they're not going to reduce this $132 billion in debt down to $50 or $60 billion anytime soon, but they can incrementally pay down some of this debt that's coming due because they have large cash balance, they generate strong cash flow, and so they can be opportunistic here and pay down this debt, which will then help their profitability as well because that's lower interest expense. AT&T has been doing a better job than Verizon in this metric as well. All right, so far what I've seen from Verizon and AT&T, AT&T appears to be the better company, and it's trading at a lower valuation at a forward price to earnings of 7.462 compared to Verizon at a forward PE of 8.533. Investors should not expect any growth from these two companies. If you get growth, you should be pleased with that. That's just like icing on the cake. Verizon and AT&T are not companies I would want to invest in right now. They're just too capital intensive, zero growth, and the industry is not my favorite industry because of what I mentioned earlier. Every few years, every new generation of technology, they need to invest billions of dollars to stay relevant. They've got massive loads of debt and the market is not growing. So it's not my worst favorite and it's not my most favorite industry. And the valuations are reflecting that. However, they're not expensive. They're trading relatively cheaply. However, if I had to pick one of these two, I would pick AT&T as my choice for the better dividend stock to buy today. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.